In this video, we're going to talk about Rivian, trading under the ticker symbol RIVN. Right now, there are massive movements coming out of the stock and in the market in general, and it's very important to stay up to date with the latest price movements. In today's video, I will be covering the technical aspects, how the stock performed over the recent trading sessions in order to identify what should be the overall approach, as well as my opinion. Before the video begins, just a quick heads up that the videos are based on trading sessions already completed, and not all of them are recorded on the same day they're posted. If material events occur afterwards, I will then make follow-up videos to reflect those changes. With that being said, let's begin with today's topic. Rivian is an upcoming startup specialized in the development and manufacturing of vehicles and software solutions within the EV sector. Its vehicles aim to meet and excel in safety, performance, and durability. It provides both retail sales to individual end users and fleet management for business clients. It sells similar vehicles to companies like Workhorse and Arrival, in the sense that those vehicles are more for transportation of goods rather than people, which is a niche within the electric vehicle sector after the heydays of 2020. After it went public back in late 2021, Rivian was the largest IPO of the sector in the recent history. Of course, it'll be facing the opportunities and the challenges of the sector and the economies around the world at large, making it an interesting company to follow up. During the trading session on Monday, the stock was going through a relatively constant effort to set itself at a higher support level, and around noon, it began retracing back from around $66 to around $62, which was tested twice and has been bouncing back from there ever since. From there, we can conclude that there is a decent support line at around $62 for future references. This may also suggest that the timing may be ripe for an entry at the moment, as long as the risk profile of Rivian fits with your portfolio. When we look at the long-term price action and tendencies of Rivian, it's not difficult to determine that there will be a lot of challenges ahead. The market has moved on from the dynamic back in 2020, and going forward, we may see more capital movements from the growth stocks back to the traditional blue chips and fixed income vehicles, as the interest rates around the world are expected to increase for 2022 and onward. Within a couple of months, we've seen almost half of the company's value getting wiped by the market, and even if the tendencies are slowing down, it doesn't mean that the price is necessarily going to recover anytime soon. The trading volume of Rivian has recently been 26 million shares versus an average volume of 19 million shares. Over the previous 52-week period, its price fluctuated between $50.00 and $179.47. The market cap of Rivian is currently at $56 billion versus an enterprise value of $56 billion as well. The difference between the market cap and the enterprise value is the premium or discount, the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. Some of the examples of the impact by leverage is, for example, if the company has a lot of debt, the market may feel uncertain about the company's capacity to pay back its obligations, which in turn negatively impacts its profitability, attractiveness, and solvency. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is basically an expectation of the market that companies are able to generate more profit or to grow larger than other competitors because they have better management, stronger brand recognition, and bigger online following. It is basically what makes one company in particular unique compared to other ones within the same sector. In other words, it's not a tangible asset that companies can use, but it's often the reason why companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value when the enterprise value includes the goodwill. So in case the company goes to liquidation, goodwill would be wiped out, and we are going to be left with potentially less assets to distribute among the shareholders and the debt holders than the figure shown on balance sheet at the moment. In comparison to its historical price fluctuations, the stock is 25% higher than the 1-month low, 25% higher than the 3-month low, and 25% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment on where the stock price is likely going to head to, the implied volatility is 123% versus the historical volatility of 94%. The put-call volume ratio is currently at 0.66. It's normal for most stocks to also tend to have a higher put option volume than what they deserve because many institutional investors choose to hedge their exposure by buying put options. The most recent volume of options traded was 48,000 contracts in a day versus the 30-day average of 54,000 contracts in a day. Regarding the open interest, the most recent volume of open interest was 303,000 contracts versus the 30-day average of 242,000 contracts. So, in terms of the shareholder structure, institutional shareholders own about 64% of the company. The biggest ones include Amazon, BlackRock, and Vanguard. It's relevant to an extent to know the shareholder structure of any company because it helps us to understand if you should be holding the company long term or to view it as a trading opportunity. If the stock is mainly held by retail traders, then it may be a sign that the stock lacks the depth to justify long-term holding. The usual consensus is about 25 to 30% of institutional participation for the company to be perceived as an investment and not just a trade. Obviously, a lot of exceptions would apply here, since many great companies are also held by retail investors and not institutional ones. But so far, this is the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are significant short interest in a total volume, this is the sign that something organized is going on. The current short interest is 8.5% of the total float and 63% of the dark pool transactions. Now, let's also take a look at the indicators. Financial indicators would give us a rough idea of what should be the overall approach in the very near term. Oscillators are showing 1 sell, 9 neutral, and 1 buy, with an overall tendency of neutral. The moving averages of the past price actions show about 7 sell, 1 neutral, and 3 buy, with an overall tendency of sell. Now, keep in mind that indicators often show the present and the past performances, but rarely predicts accurately the future. Nevertheless, they are relevant to determine if the timing of the trade is a good one. Regarding the pivot points, which are levels of support and resistance sprinkled in the price trends, the support levels are $17.38, $39.08, and $41.56. For the resistance levels, they are $70.95, $76.15, and $81.36. My opinion on the company is that it's worth your time to look into it, as it is a company that is massively owned by institutional investors, and which does have a significant amount of potentials for the years to come. It also has a lot of potentials in the sense that its price may reach a point that is sufficiently low for our portfolio to bear the risk. I would recommend to keep an eye out for the stock once the price is stabilized around a certain price range, and that would be the moment I would recommend to enter the stock. Obviously, keep in mind that the risk profile of Rivian is higher than other blue chip titles, so definitely tread the landscape carefully as you deal with it. I would recommend a maximum exposure of 3% of the portfolio, and to buy in batches of 20% of the allocation or less. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.